3M's dividend yield is currently at 4.04%, but the stock is down over 16% in the last year. So what are we doing with 3M? Should we buy more? Should we sell and dump? Or should we continue to hold? Hey, what's up? I'm Russ, and I am a passionate dividend growth investor who's going to take a look at 3M. I'm in the same boat as many of you. I've been buying 3M since it was right around $200 a share, and now we're down into the 140s. So let's take a look at why 3M is down, and then we'll look at the chart, and I'm going to tell you what I am currently planning on doing with 3M. The 3M company operates in the fields of industry, worker safety, U.S. healthcare, and consumer goods, and was founded way back in 1902. Now, 3M has paid dividends without interruption for more than 100 years and has increased the annual dividend for 64 consecutive years, but could that dividend now be in jeopardy? Now, 3M is facing two legal battles, which could end up being very, very costly for this big, beautiful blue chip dividend stock that many of us in the community absolutely love. So we're going to take a look at the first of the two lawsuits, which is the PFAS lawsuit. Now, PFAS, or polyfluoroalkyl substances, were first developed in the 1930s and had consumer product usefulness in that they repelled water, oil, and grease, and were used in common items like popcorn bags, stain-proof rugs, waterproof clothing, and nonstick cookware. Some studies show that PFAS, which is no longer produced in the United States, can cause such things like cancer, kidney, and liver damage and suppress immune systems. And there's a bunch of lawsuits that are all starting to be filed now that show that these companies dumped polluted water into waterways, and it's affected thousands of people. So this is basically the foundation of the first lawsuit. And several trials are currently underway, with more in the works. And according to a Bloomberg article, analysts think that settlements and remediation could range from $10 to $30 billion. Now that seems pretty bad, but it's not the worst of it. We saved the worst for last, which is the military earplug lawsuit that's been in the headlines and been in the news lately. And in a nutshell, what this one was is that in 2008, 3M bought a company that made these earplugs. Now, they made them from 2003 till 2015 when they were discontinued. So the earplugs were supposed to have this special filter that kept out really loud, harmful noises, but still allowed the wearer to hear voices. And this was ultimately defective. The first Bellwether lawsuit was filed in December of 2018, and 3 military veterans were awarded $7 million. Now, 3M has been found liable for the hearing loss of 8 plaintiffs in 5 trials, but 3M has successfully defended 5 other lawsuits. Now, like most things in the courts, it takes a long time to move through, and it's going to be probably years before the dust completely settles on this, but analysts are thinking this could cost 3M anywhere from $10 billion to over $50 billion when it's all said and done. Now, after 3M pays out the dividend, they keep about $2.5 billion in cash. So that's obviously not enough to cover the settlement and remediations that are going to have to be paid out. So if they want to keep that dividend intact, which has been growing for 64 years and has been paid uninterrupted for 100 years, over 100 years, they're going to have to get creative with getting money. And they're going to either do that through selling assets, they're going to have to issue shares, they're going to have to divert free cash flow, a lot of it, not back into the business, but toward paying these lawsuits out. But I think what they might do is they have a really good credit rating, so they will most likely borrow the money and use borrowed money to keep that dividend intact. And I think this is why they raised the dividend only 2% in 2020 and have had 2 back-to-back 0.68% token increases the last 2 years, which is just simply to preserve cash. And looking at the weekly chart, which is also pretty bad, it's a very serious falling knife that we have here on the chart. This is the weekly chart, and I see the next support at about $140, and after that, about $130, where 3M hasn't been since May of 2020. But money continues to flow out of the company and out of the overall market in general. Now, as a dividend growth investor, that 4% yield is juicy for a company that's been increasing the dividend for 64 years and paying it uninterrupted for over 100 years. But there is much risk and uncertainty with 3M right now.
Even Yoda cannot see their fate.
And we can't see where it's going. We just don't know the future. So people are taking guesses, and I think the market has a lot of this baked in. I just don't know if it's going to come to the 130s or the low 140s. So I'm going to buy more, but as of right now, I'm holding the shares that I do have, and I'm going to play that little bit of a waiting game unless, as they say, don't try and catch a falling knife. As we saw on the chart, the big red candlesticks down. You don't try and catch it because you can get caught. You wait for the knife to rattle around on the floor a little bit and start coming up before you pick it up. So I might just do that and see if we can find a bottom on 3M before I go buying, because chances are, even if I'm getting at 3.5% yield, I think that's just still really solid for this big company, and I think this is going to blow over in a few years. So what do you think of this whole legal situation? Are you staying away from 3M? Are you going to buy more 3M? We'd love to hear. Share it with the community. And speaking of buying more companies that have been beaten down and taken out to the woodshed, I'm buying more AT&T, and I had a really nice discussion with fellow dividend investor Ryan Williams in this little box next to my head. You can click it, check out some of that. It's about a 30-minute conversation we had the other night, and if you will do that, then we will talk to you there.